To give you a little bit of background information about our presenter today, after graduating from the University of Michigan with a Bachelor's of Arts degree in economics, John Morrill began a career in the life insurance industry. After 4 years in personal production, John was asked to join a Midwest regional broker-dealer as an insurance coordinator and work with their financial planners, expanding their life insurance sales. In 1996, John and his wife moved from Michigan to Colorado to follow a personal desire to live in the Rocky Mountains, and John began working at Security Life of Denver, which is now a piece of ING's Life Group U.S. portfolio. So with that, I'm going to turn the time back over to John. Make sure John has the screen.
Thank you very much.
All right, John, it's all yours.
Thank you. I appreciate everybody taking a few minutes out of your morning to join us. I've been, for about the last 4 years, directly supporting offices, spending time in the field with Insurance Network America. And my goal is to help you with different sales ideas, obviously product knowledge of how ING where our products fit in those niches, but more than that, just to make you successful as an agent, helping helping identify clients' needs and helping find the concepts and tools to make a sale. So what we're going to talk about today is a little bit of backstory to what our little tool is. It's called Step It Up. It's a one-pager, and reach out to Tim afterwards, and we can make sure you get that and spend some more time if you want to go through it a bit more in depth. But we're going to talk about what we had built this tool or this piece was to help folks who may not be 100% life agents identify where they can go and find more sales. It might be, you might actually use this with a CPA or a P&C agent or a health agent, or maybe that is your mainstay of what you do, but you'd like to branch out and find some more or find some life sales. A lot of people are looking to diversify revenues. So let's sort of talk a little bit about kind of where we are. There we go. Just to give you a bit of background, kind of where our, and this is not a sales talk, it's just really going to give you more ideas, but to give you an idea, I won't say a sales talk, it isn't a product pitch. We have 3 niches that we believe, not only for ING, but in the industry, we're going to continue year in and year out to have significant sales and a significant desire for producers and advisors and clients to have these types of products. One, obviously, in the top is the term product. Last several years we've seen a plethora of term sales. People know they have the needs, a need for death benefit, but they aren't ready to part with permanent types of premiums. So that's been a mainstay. We're going to probably be in about we'll probably issue about 160,000 term policies this year. We are the number two or three writer, depending upon how you parse out the data of term insurance. Guaranteed death benefit on the bottom left-hand side has come as a reaction of the fact that, those VULs and old ULs, they aren't doing what they were supposed to do. Well, let me change that. They aren't doing what they were illustrated to do. People, attorneys, CPAs, clients, say, you know what, I want to know what the premium is, and I don't want you to come back and tell me it's something different. So that's a big piece of the marketplace. And then index. It has eclipsed VUL in sales last year. It was up 114% on premium last year over the year before. We are seeing record amounts of sales. Why? Because people want to have a little bit of upside, have some upside being exposed to the market, but not have unlimited, downside of a VUL or being directly in the market. So it's it can be a great opportunity or a great product to fit in a client's needs. One of the things that we're going to sort of talk about is that Step It Up. See, that was quick. That's the only real ING pitch. Those are our niches. But let's talk a little bit about where we think, and I hope you can read this, where we think we can help you identify sales and end up doing some marketing, help you find some niches in your book of business, in your prospects, in your natural marketplace to go find some more sales. We built this for groups of agents, folks that aren't really in the life insurance business all the time, but they might have different types of people that they work with. And all we wanted to identify or help them identify was not teach them products, teach them concept, and now they have these two things and they got to find someone to fit it. These 7 different, we call them steps, but these 7 different identifiers identify who the prospects are inside of that person's book of clients. And it might be a CPA, it might be a benefits person, it might be, who knows, it might be a mortgage broker, it might be somebody that really hasn't looked at the life insurance side too much. But what this does, it identifies the prospects by what their criteria. So let's take a look at business owners here. Who fits this profile? It doesn't say all the different concepts and products we can sell them. It says these are people that want to keep the business in the family or pass it to other chosen persons. They want to assure a fair value when they pass it along, and they want supplemental retirement income for themselves or key employees. So we're not really identifying a sales concept, but really what we're going to do is sort of find 2 or 3 different niches. And for each one of these, we've got, our software is dynamite. We've got really good illustrations, not just a ledger, but be able to weave it into a story. We've got a wonderful business continuation or buy-sell. You don't have to be an expert in it. You just sort of read the pages, and it talks about if you don't have a written buy-sell, then there's only 30% of the companies make it successfully down to the next generation, and so on and so forth. Great quotes in there. Talks about what are the next steps. But these are all different sort of niches that Tim and I have sort of worked over the last since the seminar up in Boise to say, hey, identify 1 or 2 of these, and let's help you identify product and concept in some of those things, or give us a prospect and let's do some brainstorming and help you figure out what they might need. So going top to bottom, there are, the wealth transfer is, estate planning. Well, it's kind of a bit in flux these days. Who knows what's going to happen? But the wealth transfer and income tax planning. Things to think about these days is, do you have some super wealthy clients that might be able to make a gift of $5 million per spouse down to the next generation? Do you have people who have a sizable enough estate that they don't want to give up an annual gift that if they don't make it by the end of this year, it's gone? Maybe that's somebody to go and prospect to. Again, business owners, we just talked about them. Next 2 sort of steps are IRA preservation. Gosh, this is a pretty powerful one. People who are age 70 and above have a large, decent-sized IRA. They don't need the asset. They're going to start having to take, and it was funny, it was a presentation I was co-presenting with one of my counterparts out on the West Coast, and he was talking to a group. He said, this is one of those letters that people hate to get. It's the birthday card they hate to get. It comes from the government, and it says, Dear Mr. or Mrs. IRA holder, qualify, you're almost 70 and a half. Guess what? You have to start pulling money out, and we're going to take our piece of it. Required minimum distributions. That's a perfect opportunity to go talk to them, because we can show them that an IRA getting passed down, especially if they have an estate tax issue, getting passed down as a death benefit or to a beneficiary of that IRA is probably one of the most inefficient ways of moving it down to the kids or grandkids. Let's talk about a tool that we know and love called life insurance. And we can use ILAs, we get it outside. Anyway, really neat things. Again, IRA preservation, people who are old enough that they know they don't need it, they want to continue some sort of tax deferral, they like the diversification, and they don't want their kids to pay income or state taxes on them. Great, we could show them some great tools. Same thing on the annuity side. but instead of an IRA, it just fits into an annuity product. Going down here, B trusts. If you have a widow or widower who had done some estate planning, have money sitting inside of a B trust. So that would be, there's an A in the B trust and the estate planning. If they have one, gosh, that's just money sitting there. They're probably not doing very much with it. That's just money that's ripe to do a single premium life policy on the surviving spouse. Next one is a Roth IRA alternative, and we're going to actually focus on this a little bit. But everybody's going nuts about the Roth IRAs. Why? Because they pay the taxes today. As I learned 20 years ago, and my sales manager kind of walked me through all the different parts of the business, we were talking about life insurance retirement plans. And he said, why would people, or I should say, doesn't it make more sense to pay tax on the seed and not the harvest? Well, that's the seed. Paying tax on the harvest is what you see in qualified plans and in regular IRAs. People are really excited about the Roth IRA. We'll talk a little bit about that. But if you have somebody who is young enough that they might want to think about moving a qualified money into a Roth IRA, or the fact that they just want to put aside some more money because they've maxed out their 401k, life insurance can be a great tool for them. Maybe they don't have a 401k at work, or lots of different criteria. Portfolio or life insurance review. Gosh, you should be asking everybody. And I know the folks at INA, Tim can help you go through them. I can help you go through and figure out. In fact, we just came out with a buy-sell. I'll show it to you in a few minutes. A buy-sell process where you can ask them about business planning and ask them some probing questions. You don't have to be an expert at it, but just try and uncover how long has it been since you've had your buy-sell. Oh, you don't have one. Oh, you do have one. Is it funded? What's it funded with? How long ago was it that you reevaluated the value of the company? Do you think you have too much value in your buy-sell versus what it's worth, or vice versa? Lots of different questions to ask. We want to make sure you have the tools to go out and probe and ask those questions. So life insurance review should be a checklist on what you're doing, whether you're doing retirement planning or you're doing health benefits or you're doing P&C. Say, hey, you know what, I'm finding that a lot of people in this day and age, and with the way the economy is going and interest rates and everything else, they've been busy on other things, like maybe sending kids to college or working a second job and some of those things. Have you looked at your life insurance? You might be overinsured. You might be underinsured. You might be paying too much for it. You might need a different type of product. Let me help you. I got some experts who can help you. So we're going to spend a few minutes and kind of walk through a little bit of a sales process of an overfunded life insurance policy. We're going to use our global index product as the recipient or the bucket that we're going to put the money into. We're going to talk a little bit about how can we set the stage and where does it make sense. I've always been a big believer in diversifying people's retirement, spigots they can pull money from. There's a lot of different things you can do out there. There's qualified plans, comes out down the road taxable. There's non-qualified folks, things that people do just on their own, buying a mutual fund, Vanguard or whatever else, doing some annuity planning. But also life insurance has kind of been that forgotten tool. Life insurance gets a lot of grief out there. Dave Ramsey and other folks like that. Yeah, there's a lot of folks that they might be better served by just term insurance, but gosh, if somebody has some extra money or they need that death benefit a bit longer, life insurance is kind of that forgotten tool. Oftentimes it's not sold right to accumulate, but when you do accumulate it right and build it right, it can make a lot of sense. We're going to talk a little bit about our index product. Index, this is our disclosure slides. Index is not an investment in the stock market. That's the power of it, is you can enjoy some of the upside potential of being in the market, but your money, your principal is never at risk. And that might be something that Tim or I could walk through on a different call and say, hey, how does it work? I've had many questions from very seasoned veterans saying, help me understand why I don't need a Series 6 or Series 7 or broker-dealer affiliation. Tell me why the client's money really isn't, because they're in the market, aren't they? Well, no, they're not, but that's an hour discussion, a good one to have at a different time. They don't actually participate in the index itself. It's just a measuring tool that we use. Cash value is based on the performance. It's not based on the performance of variable option. It is not meant to be an investment tool or investment vehicle. And I tell you, it can be a real nice option to some of the other things out there. Let's talk a little bit about what our next few slides are going to be discussing. We're going to talk about taxes. I don't know. I'll go ask 10 different folks in the business, and I'd say 10 of them. All 10 of them say taxes aren't going down. Most of them, probably 9 of them, say taxes have to be going up. So we're going to talk a little bit historically where have taxes been, both income taxes, investment, and estate taxes. We're going to look at a tool that we have in our software, and please get a hold of Tim or myself, and we'd be happy to send you a link. We walk you through it. Some real powerful tools in there to help show clients and help you plan for some of their retirement and different things like that. But this is a investment value calculator. How does it work? What can it do? What can how can you utilize it to really model some of your clients' needs? And finally, we're going to look at, okay, well, how could life insurance fit as a complementary product inside of someone's planning? Do they need life insurance? Do they need investments? Well, sometimes those things can go hand in hand and really make sense. So let's sort of back up, to historically, what have tax rates looked like? And this is this is the top marginal rate. Not talking about the break points, but let's just look at the top marginal rates and really what's happened to them over the last 30 some years. They're historically low, and if you look at the fact that we're spending as a country 40 cents out of every dollar we're spending is borrowed, where are taxes going? I don't know, but they're probably not going down. It's always been the old adage: when you retire, you'll retire in a lower tax bracket. Well, I think we're all hoping that we're not going to retire in a lower tax bracket. I don't expect them to lower the tax bracket, but we're all hoping that we're not going to have an income that's going to be any less or not much less than what we're earning during our working years. But I'd go so far as to say taxes are going to go up some. Let's talk about the long-term capital gains rates. Right now, they are delinked from ordinary income taxes. That's a very attractive thing when you are able to hold an investment, a mutual fund, a house, a piece of property, something for more than a year. You only pay 15% taxes. So you have the ability to do some real good tax planning. But again, it's historically pretty darn low. Finally, on the federal estate tax, the marginal rate is low, and the exemption, the applicable exclusion amount, is high. Where's that going to go? Oh, you talk to different folks who know, quote, or in the know up in D.C. There's discussions about dropping it back to $1 million, going back to 3.5. We all thought it was going to be, at the end of after 2010. Who knows? But right now, for the next year, this is where it's supposed to be. So, what I'm going to do, let me flip over to another piece, and this is something that I pulled from a presentation done by, I don't know if you've seen the books, Tax-Free Retirement. A Tax-Free Retirement is written by Patrick Kelly, and what's powerful about that is he's got 2 slides in here. There's a lot of overlap in between what I just went over and most of his presentation or his pages. Hope everybody can see that. I'm not a go-to webinar expert, but Tim, if you can't, let me know.
Good.
Excellent.
We can see it.
The one thing I'll throw out there is when you're talking to a client, one of the things that I like to sort of, to sort of set the stage is they probably have another investment advisor. And one of the things that, a good investment advisor will do is to say, Mr. Tim, here's what I do because I'm a sophisticated investment guy, and I'm gonna do the best I can in based on your risk tolerance, investing your money. But one of the things I really focus on is being tax efficient. I don't want to have too many investments on the right-hand side, ordinary income, when I can move it over to the left-hand side, capital gains. Let's say clients have 30%, 35, whatever, in between federal and state and local taxes. Ordinary income, when I can move them to the left side and bring that down to 15%. They say, well, don't forget, it's not always been that big of a delta, that big of a difference between ordinary and capital gains as it is now. But one of the things that a lot of people forget about, and this is sort of the other discussion I like to have, is don't forget that those are all taxable, and it's great to move things to the left because it's only 15% tax bracket. The wealthy have for years been buying muni bonds. Why? Because they're triple tax-free. Now, in my own head, it doesn't, John Morrill, it doesn't make a lot of sense to me because you take a reduction in the amount of return you get to not pay taxes. I'll be willing to pay a lot of taxes if somebody gives me a lot greater rate of return. But muni bonds don't. That tends to be for, old widows or super wealthy that just sort of clipping coupons. Well, that's not really, coupons to go to, Safeway, but that's, bond coupon payment. So, but there's also Roth IRAs. People have been real excited about the Roth IRA. Here at ING, we actually have an option between a 401k traditional and an IRA and a 401k Roth, and that's a real attractive place to go. Why? Because people say, I want to put my money in today because I don't want the government telling me down the road what percentage of that savings account they're going to take from me down the road. So Roth IRAs, but for most of our clients, they've maxed out. They don't have the ability to really do very much in a Roth IRA. The third one is life insurance cash values. That's usually when the client gives you a hairy eyeball and you say, no. I understand that you have had a bad experience, or I understand that you may not think that this is a great place to put money or as a tax-free alternative. But let me tell you what, one of the things that I work hard to do for you is to sculpt that life insurance policy to have, minimum death benefit and maximum growth potential, so we keep those expenses down and keep your savings high. So anyway, that's I digress for a moment. Let me see if I can get us back to our presentation here. Well, I guess I can skip down from here. Here we are. So what are we going to do here? Let's talk a little bit about. There it is. Let's talk a little bit about what happens. What's the comparison? What happens if you have an age 50 or a 50-year-old successful guy, and he and his advisor have basically determined that he needs to put aside an additional $20,000 per year until retirement, age 65, and target an 8% hypothetical gross rate of return to supplement his income from 70 to 90. His objective is to, our objective is to look at the impact of the taxes and expenses on the non-qualified asset to help Mr. Successful make an informed decision. Now, what we're doing here, and this is where I sort of bragged about our software, we have a hypothetical tax calculator, hypothetical investment calculator, where you can go in and plug in all of these bits of information. This works real well. Colorado and many states out there. I'm based in Denver anyway. With the federal's 30% or 35%, whatever number you're going to put in there. Here's the state tax brackets. So you can plug in based on your location. Heck, I was just reading a thing where I grew up outside of New York City, and did you know there's a 12% state and local tax, and that's insane. And so you can change this to really reflect where your client is. And some states have 0, and then you can say what proportion of the returns of this, and this be some sort of mutual fund type investment, what proportion of those returns are going to be allocated to dividend income, short-term realized gain, long-term realized gain, and then long-term unrealized. So you don't pay that until you actually pull the money out of the investment way down the road. And I'll offer that this is an extremely well-run, this is a hypothetical imaginary one, extremely well-run, tax-efficient investment that's able to get 8% rate of return. Usually they have much greater turnover, a lot more short-term realized gains, those sort of things. But the other thing you can do is you can go in and say, okay, what are the expense ratios of this investment? And that's expense ratio, we're showing a 50 basis point expense ratio, we're showing a 0 transaction fee, 0 sales load, and a 50 basis point advisor fee. Again, I'll say that this is probably not a product that's nearly this efficient out there that could ever get close to 8%. Even ones that just invest in bonds that aren't really managed very much, S&P 500 that aren't going to have this inexpensive plus that type of tax structure. So if they put in if the client puts in $20,000 to age 65 and then pulls it from 70 to 90, they're able to pull out $54,000 a year. So this is in today's tax world. So let's say, well, what's going to happen? And we first had this presentation come out about a year ago when we were expecting the Bush tax cuts to expire. And people said, gosh, well, it's not going to make that big a difference, is it? Well, guess what? We could go into our little financial tool in our software. We could plug in the expiration of the Bush tax cuts, and it just went up to 39.6, 20, and so on and so forth. Same expenses. Clients just lost, what, $3,000 a year, or over that 20-year period of time, they lost almost $54,000 worth of income just with this little expiration. Now, states are all hard up for, you know, they're not in the black, many of them. Let's put it that way. They are extremely, they're extremely anxious to try and find some more revenues. So is this going to go up? I don't know. Is this going to go up further? I don't know that either. But just this little hiccup caused a $54,000, about a 7% drop in income. So I guess that sort of begs the question: Is insurance a good tool? And we're just taking a look at, cash in and cash out, and look at the scales of justice. Got the lady with the 2 scales. The important thing, life insurance makes sense as an can make a decent investment type of tool. Not just ours, but we think we have a real good handle on this is talking about our global index products, but I think it's it's a wonderful place or a product to use. But at the end of the day, insurance makes sense when the expenses that you pay to have the policy are less than. Hang on a second, there we go. Are less than what you're saving in taxes. So for someone in a 15% tax bracket, or let's say you're working with a company with all sorts of carry forwards and aren't going to pay taxes for a gajillion years, the savings aspect of taxes, the paying less in taxes on life insurance may not outweigh the expenses in there. But if you have somebody who is in a top tax bracket, and you have somebody that doesn't have another bucket, another tax preferred bucket to put money into, it probably makes sense to at least look at it. So we're going to take a look at, we're going to do a option 2, so we're going to really build it as efficiently as we can to keep the expenses down. $353,000 worth of death benefit for this 50-year-old. We're assuming they're preferred. Standard makes a little bit less income, but it's not substantial. Option 2, we're going to flip it after you stop paying premiums. We have a 1% floor. We're running an 8% illustrated rate and participation rate of 65. So all those different pieces. But we're saying, okay, let's say we could get a similar type of return on the policy as we're expecting on the other investment. Well, now we're pulling out $64,500 a year. which even before, even in today's tax world on the other comparison, that's about a $10,000, $8,000 difference. I think people forget that this is really a good tool, and we aren't putting any value on the amount of life insurance that they just bought. So again, just one of those things as you're doing some planning with your clients to say, yeah, there's a lot of different places we could put money. I don't believe that this should be the only thing that people invest in, although there's some pro athletes we've been doing this exact program with, and they're putting ridiculous amounts of money in there because it's, that makes sense for them. For a typical client, this might be a good tool, especially if they need life insurance anyway. Lots of different things we can balance. And again, we aren't even talking about $353,000 worth of life insurance. There's different aspects of where it can be used. You've heard a lot of corporate-owned life insurance. We're seeing much life insurance being sold to business owners. Most of it personally owned because of 409A and everything that happened after WorldCom and Enron and some of those things where there was some shenanigans going on about the higher-up executives pulling money out before the company went down. So we're seeing more and more business owners taking a look at insurance as a sheltering vehicle, ability to shelter it from bankruptcy. Certain states have tremendous creditor protection that wraps around that life, and because of the life insurance, wraps that cash value. Most of them need buy-sell planning, all sorts of different things. So there's lots of different. Most people need life insurance anyway. They're just buying term. Well, now they're using a little bit of money that's being wasted that they could put towards a calculation and say, does it really make sense long term if they're in a tall tax bracket? Our product is 3 points on the globe. We take 75% of the best performing, 25% of the second, and calculate from there. So, really what we've done is kind of walk through, historically where does that work, the different tools we can use, that investment value calculator. I'd highly recommend you give Tim or myself a call, and we can go get the software on your computer. Let me actually, I've got a few minutes, walk through a couple other, let's go back to the business owners. A lot of, many agents that I spend time with, you have a, just focused on the individual side of planning. And it's really been a transition that with just a few questions, with just a few, probing, a questionnaire or a white paper going out, or if you meet with them, say, hey, tell me a little bit about your business. Tell me a little bit about what your plans are to pass it down. And two things, and I'll wrap up with this. I always like to leave with a nice, quick sales idea. We just came out with, and this is on the website. There will be an email going out today. This is brand new. We've had so much interest in agents being able to, have a conversation to flow from the personal discussion over to the business discussion, that we've come up with a buy-sell review kit. Lots of different things out there in the marketplace. What we want to do, here's the important questions in the buy-sell kit. This is pretty powerful, where you look at, this is a quick hitter, 11 questions about the business owner's current plan, 6 questions about the agreement, and the remaining 5 are about the funds set aside to implement it. I want to, here, fill this out and mail it back to me, or fax it back to me, or email it back. No, just go through that. Just have a couple of these kind of on the tip of your tongue as you're talking to somebody. There's a policy review fact finder. Ask about, basically, with this information, the client should be able to figure out the state of the policy, kind of the status of the policy today, how each policy might perform in the future, what different life insurance options are available. I got this question from a fairly new group. I was doing some sort of insurance 101 teaching, and they said, when I first got in the business, I was told go out and sell a whole life policy or UL policy and get the check. What's better off? What should I do if a client needs $250,000 worth of insurance? And I had some flashing red banner pop up on my, sorry about that. What should I do? Well, if they need $250,000, they can only have enough premium they can afford to buy $100,000 of whole life, sell them $250 of term. Show them the options to take care of what they really need. I think there's a lot of great options out there. There's guaranteed death benefits. There's we just came out with a hybrid product that it's going to be a great complement for somebody who's younger that wants some guarantees, but gosh, they don't need it to 121. What a great way to balance those two needs out. Again, and this is in our final piece that'll be out later on to the public today. This hasn't even been released, but questions for the buy-sell review in life insurance. It asks more in-depth questions. So this first piece is just kind of 11 questions you might want to go through, a couple times and do some role playing or whatever, and then you end up with the, sort of more in-depth questions, asking about a little bit more about what their plans are. Have they thought about, selling it to, hey, are your kids interested in doing it? Hey, all sorts of different options there. Trying to see, I think. Anyway, that's a great piece. The other one, and I'll close with this, and then I will really be done. There's a 101J has been a very interesting discussion to have with business owners. 101J is a code section inside of the Pension Protection Act of '06, and it's been really, really interesting as I've, in travel, sat in front of, pretty significant attorneys or CPAs, in a town. Oh yeah, I'm working with this business planning attorney, and so we sit down and we start discussing the case, and I ask them, just real quickly, what have you done on the 101J aspects with your clients? 101J basically says if a business owns life insurance, the business owns life insurance, and there's two things that the business must do. One is having consent for insurance. A lot of them have that. Second one is an 8925 form. The 8925 form is, and this is our brochure on it. Again, this is just an educational piece, but it talks about there are right over here. There's 5 things that consent and this form needs to be filled out and signed, and we have boilerplate documents. Puts in the employment file of the employee. You'll find over here it talks about August 17th of '06 is when, from that date on, absolutely the businesses must do that. The other one is the tax form. CPAs look at you like you have 3 heads. If you say, "What do you?" I'm sure this must be, businesses must fill this form out if they own life insurance on their employees, definitely if it's been issued after August 17th of '06. 4 lines, easy. How many employees? How many employees are covered under insurance? Total amount of insurance in force? Do you have a consent for insurance? That's that other form we talked about. And finally, oh, by the way, that question is yes, and then they have to fill out, there. But this has to be no clue. And if they don't have these 2 things done, guess what? That $1 million buy-sell or that $500,000 key man policy, when that death benefit shows up, if they don't have these 2 things done, it's a taxable event. That's a big aha. So I leave you with a generic sales idea, a great opportunity, and a great way to get in front of, if you're talking to business owners, if you're talking to folks who get in front of business owners, to say, there's a good chance you don't know about 101J. Let me tell you what it's all about. You may not, you're probably not the culprit, but what a great way to get in front of your clients, talk to them about this, show them your expertise, and the only way that, the only clear way to repair it is you you current date the insurance by rewriting it, which you can usually find better insurance, cheaper premiums, less death benefit, better needs coverage. So with that, I think I'm going to give you guys, ladies and gentlemen out there, a few extra minutes if you've carved out an hour. Tim, anything that you'd like to add or jump in on?
Well, no, mostly just to thank you again for your time and going over this with us. And for all of you attendees on the phone, we're going to make sure that we touch base with you to make sure you have the Step It Up tool that John talked about, the investment value calculator, and this new buy-sell review kit. If you have any other questions on that, feel free to ask us at that time. And again, John, just want to thank you for your time.
My pleasure. Thank you for having me.
All right.
Have a good morning.
Have a great day.